Hello, everyone, and welcome to today's webinar, Powering What's Next, How Electrification Reshapes Infrastructure and Investing, or Infrastructure Investing. I'm Megan Millett. I am our Events and Member Services Manager here at CFA Minnesota. And I'd just like to thank our sponsors today. Without these sponsors, we couldn't be doing programming like this and everything else we do throughout the year. So now I will hand it over to Ben to introduce our speaker, Paul.
Hello, everyone. Thanks for joining us today. My name is Ben Kirsch. I'm in sales over here at Alps Advisors. We're based out of Denver, Colorado, but I cover the Minnesota Midwest region and may have met some of you over at the different CFA events, annual dinners, and such. But appreciate your time today. Before I get started, I'm going to introduce you to Paul Bayaki, who is our head of sales and fund strategies, heading up our distribution as well as everything that we do with our partners, our distribution partners, and our in-house funds over here at Alps Advisors. But what we're going to talk today, Paul is going to talk today about really the electrification of everything that we have. And we're seeing it just about everywhere, whether you're in Ohio, Colorado, Minnesota, data centers are being built out quite extensively. And we share something being here based in Colorado and in Minnesota with Excel Energy. And they announced a project in February of 26 to power a new Google data center that's going to be out in Pine Island. So, wherever you are, it's touching our lives. And Paul's going to touch a lot on some of those aspects and how we're going to see that really play into our lives, not only here in the near future, but also on the horizon, the 5-10 year plan. So, Paul, take it away. And again, thank you everyone for joining.
Yeah, thanks, Ben, and thanks as always for taking some time out of the day to spend with us going through a topic that is very much near and dear to our heart. And I think Ben touched on something important here, which is AI data centers, and we'll definitely dive into the impact that AI data centers and their insatiable appetite for electricity is having on the grid and on projections for electricity demand, both in the United States and globally. But the reason we've titled this "The Electrification of Everything" is because it isn't just about AI data centers. They capture a lot of the headlines. AI is certainly top of mind for investors and certainly for advisors operating on behalf of investors because of how much of the market narrative and how much of the headlines have been influenced by AI and the development of these various large language models. But what's interesting to us is the stacking of emerging sources of electricity demand. And we'll go through some of those in this presentation. If we can leave you with anything today, it's really the idea that first and foremost, electricity demand is growing at a rate we haven't seen since the late 1960s and 1970s. And the implications of that from an investment perspective are critical because you don't own a lot of the companies in a cap weighted view of the market that are going to be responsible for capturing the increasing electricity demand. You have a lot of exposure to the companies driving rising electricity demand. Think Mag 7, think communication services companies, hyperscalers, and the like. What most people don't have a lot of exposure to are the companies at the heart of the electrification of everything and this electrification infrastructure theme. So let's just kick it off as you typically do in a presentation like this with a hockey style chart, if you will, for those of you in Minnesota. And it's not often that you give a presentation and you don't have a chart that's going up and to the right. And this is exactly what you see. So here's FERC, the Federal Energy Regulatory Commission's forecasts for electricity demand. And what you can see is in 2024, which I know doesn't feel like that long ago, or maybe does feel very long ago, depending on where you sit and what you do. The baseline forecast for electricity demand growth in the United States from FERC was pretty significant in terms of the steepness coming off a period of 25 years or so, where electricity demand was basically flatlining. It was growing at 0.4% annually. And then at the same time, they started to adjust their forecasts for the implementation of AI and the demand that's coming from data centers, as well as electric vehicles, as well as reshoring plans. And so what you see here is a chart in which you take this period we're coming out of 0.4% annual electricity demand growth, and you go to a new baseline of 1.6, and then you stack on top of those emergent new electricity demand sources in that forecast, which we'll get into, and you add to that increased adoption of AIs, bringing critical supply chain elements or reshoring of manufacturing activity to the United States, and then you add to that AI data centers, and all of a sudden you've got a 3% compounded annual growth rate, which of course is well above what we've experienced over the course of the past 25 years. And importantly, is one of the steepest increases in electricity demand growth that we've seen going back, as I said, to the 1960s and 1970s. And most people, when we say that, ask, well, what happened then? And believe it or not, that was when you started to see widespread adoption of air conditioning in residential housing in the United States. And that just speaks to how unique this moment is, because that was a unique moment historically in terms of the experience, the lived experience of people in the United States. And this is now a new experience for us economically and to an extent from a lived experience perspective as well. And so when you think about this in an economic context, we're now taking this idea of increasing electricity demand from all of these compounding sources and applying it in an economic context. And you see these various projections here in front of you for electricity intensity of GDP. Well, what is that? That says for every dollar of GDP that we produce in the United States, how much electricity do we need? And as you can see, there was that period in the 1960s and 1970s, that period we talked about, where the electricity intensity of GDP was increasing. And really starting in the early 1990s, we started to see that number decline pretty significantly, consistently over the course of the next 30 years or so. And now, based on different forecasts, some are more aggressive than others, some are more conservative than others, regardless of the forecast. You can see that the electricity intensity of GDP is set to grow over the course of the next 25 years or so. And it's important from a number of perspectives. Certainly, all of you have seen the headlines, as Ben mentioned, around SoftBank investing in a big data center project in Ohio, a data center project up in your backyard, up in Minnesota. We've certainly seen them down in Texas and Louisiana, all across the country. These companies are committing to massive CapEx budgets to build these massive data centers, all of which have very massive needs for electricity. Because one of the other questions we often get is, well, over the course of the past 20 years, we've seen a lot of cloud computing capacity built. And you think about Amazon Web Services and Google's cloud business, Microsoft's cloud business, all of those things have been growing dramatically. A lot of what we do, a lot of the files that we interact with on a day-to-day basis aren't stored on our computer, but rather in the cloud. Why is it that all of a sudden now we're seeing a massive increase in electricity demand? There's two pieces to that. First and foremost, a typical cloud-based computing facility has much lower electricity demand and electricity needs than an AI data center. And we'll explain why in the coming slides. But the other piece is that when that happened, you were coming off this ongoing decline in electricity intensity of GDP, and you also had some low-hanging fruit in terms of excess capacity, excess transmission, excess generation in the national grid and in regional grids that allowed for a cloud computing center to get plugged in and not have a meaningful impact on the overall supply and demand outlook for electricity, regionalized or nationalized. Well, that has changed because the appetite for electricity from AI data centers is significantly higher. And it's also coming at a time where we're trying to electrify other pieces of our economy at the same time, as well as plugging in additional manufacturing facilities, reshoring activity, and the like. And so you can think about this electrification of everything, not so much as one individual driver, and that driver being AI data centers. You can think about it as this stacking function of different new, emergent, meaningful material increases in electricity demand sources. And we'll walk through those. So, before we do, here is the estimated increase in global electricity demand by sector. And you can see the data centers are and not an immaterial segment of that increasing electricity demand on a go forward basis, quoted in tetrawatt hours. But you can also see electric transport, industry, appliances, cooling, as well as sort of typical heavy industry demand sources. So it's a convergence of a lot of trends that's driving rising electricity demand. And data centers are almost the cherry on top of the pie or the cherry on top of the cake in the sense that they're coming at a time where we're already seeing a massive increase in electricity demand globally from traditional sources as well as non-traditional sources like electric transportation. And the reason that electricity demand from AI data centers specifically is so significant is because every time that a company like NVIDIA, which of course is part of the headline flow that we've seen in this AI cycle, brings a new chip to market, a more sophisticated chip to market, the electricity needs of those new chips, those next generation chips, are more significant than the last. And it's not quite exponential, but it's certainly significant, meaning as NVIDIA continues to develop, as does other companies producing both the chips needed for AI as well as memory chips, what we're seeing is that each new breakthrough in terms of technology creates new meaningful increases in electricity demand. And I'm sure all of you have seen the headlines around the obsolescence curve of some of these individual chips. And what we're seeing is that at the moment, there's insatiable appetite for the most recent vintage of an NVIDIA chip, but behind the scenes, NVIDIA is working on the next generation, and their competitors are working on chips that can compete with NVIDIA GPUs. And so, what you have is this race to extend the usefulness and maybe even the useful life of the chips that are being developed while at the same time increasing the sophistication of those chips. And that's what's putting upward pressure on electricity demand because as these companies go out and commit to 30 billion here, 50 billion there in terms of construction of a data center, they're also committing to massive orders of the GPUs, which are responsible for much of the electricity demand that is ultimately coming from the AI data center outlook. And one of the things that's really unique about AI data centers is that they're all their own. In many ways, they're kind of like a snowflake. None of them look exactly the same. They're not located in the same geography. They don't have the same approach to how they're going to go about generating the electricity that they're going to need to meet the demands of that localized data center. And so the point here is that there is no single solution to this electricity puzzle. So if you look at some of the companies here at the bottom of the chart, I'm sure you recognize them, Microsoft, Amazon, Meta, Google. I mean, you've got a number of the Mag 7 in here as well as a number of other companies who are providing data center and logistical solutions to companies with AI ambitions. But what you also see is that some of these companies have been more aggressive in terms of their commitment to using green power. On the left, you see Amazon and Microsoft committing as much as 100% in some cases to green power share in their data center projects. Where at the other end of the spectrum, from companies like Stack or even Digital Realty or Cloud HQ, you've got a lower threshold for commitment to green power. And so what we've seen is that each data center project has a different approach to how they're going about securing the electricity that they need to ensure that that AI data center turns on and stays on. Because what we all know from an AI perspective in this AI arms race is that what you can't have if you're an AI data provider or someone who's an LLM developer is when someone goes to enter a prompt into Claude or into Gemini or into ChatGPT, that you get a message back that says, sorry, the lights aren't on. We don't have power right now. Come back later. That's not the way the economy works. That's certainly not the way people interact with AI. And so each company who's building a data center project is effectively taking their own path to how they're going to go about securing electricity, whether that means going quote unquote behind the meter and having a lateral natural gas pipeline built directly to that data center project, hooked up to gas turbines manufactured by, say, a Siemens or a Mitsubishi or a GE Vernova. Whether that means going behind the meter and building your own renewable power substation with wind and solar in a geography where that can be run, hooked up to, say, some large scale enterprise batteries, or whether it means simply plugging into the grid and working a deal with the local utility or the regional utility to ensure that you're paying your own way and you're not adding additional costs to the consumers in that local area. That is the mitigating factor of this insatiable appetite for electricity coming from AI data centers is not just generation, because generation is somewhat easy to develop and somewhat easy to build, not easy, but somewhat relative to transmission. When you think about trying to build transmission lines, we all know, or I'm sure a lot of us know and have heard, that the grid in the United States is very old, hasn't been improved in quite a while. So we're doing two things in parallel. We're trying to add significant loads to the existing grid, while at the same time trying to improve that grid in real time, which is a very challenging, very complicated endeavor. And what it in many ways is going to require is akin to that Oscar-winning movie from a couple years ago, which is Everything Everywhere All at Once. And in that way, it's a mix of traditional fossil fuels like natural gas, which is abundant and relatively cheap. It's also solar, wind, as well as storage technology bolted on to those solutions. It's also likely to be at some point, maybe not next year, maybe not a couple years down the road, maybe more like 5 or 10 years from now, some mix of traditional nuclear power sources, as we've seen a recommissioning of older nuclear sites, as well as the emergence of a newer technology, small modular reactors. But when you look at this chart, which jumps out at us in terms of the forecast and electricity demand that is coming from AI data centers, these are all very distinct, very different slopes on all of these charts. But the punchline is that depending on where you sit and what your forecast is, the upward pressure on electricity demand from AI data centers is fantastic. And there's some numbers here that we can put to this. So one of the ones that I think ties into a lot of people's daily lives is, let's say yesterday you decided to do a Google search for something, as we typically do, either intentionally or unintentionally. We went onto our iPhone, we searched for something, and it automatically went through Google. Well, that takes zero point 0.3 kilowatt hours of electricity to do that Google search. Let's say today you woke up and said, I want to do the same search, but I'm going to put it into ChatGPT or into Claude or into Gemini, or name the large language model I use or that I have grown accustomed to and I've built a relationship with. Well, that same query entered in the same way into an LLM actually takes 2.9 kilowatt hours of electricity. So it's nearly 10x the electricity demand of a typical Google search. And that's important and impactful because when you aggregate that into everyone using those two services or services like them, the numbers get really big really quick. And another number that is instructive here is if you look at just what's under construction, what's been contracted, what is going to come online over the course of the next 4 years in terms of data center projects tied to AI, you're talking about 160 or so thousand, or I'm sorry, 160 gigawatt hours of electricity that is being added to the grid over the course of the next 4 years, not based on just forecasts or estimates. This is stuff that is under construction or under contract. For context, that's 15 New York cities worth of electricity demand. If you put it in the context of where we're at now, that's about 25% of baseload usage in the United States in 2025. So again, I started off by saying that AI data centers aren't the most important or aren't the only driver of electricity demand growth in the United States and globally, but it certainly has a very large impact, and some of the numbers around it are disproportionate to some of the other drivers. But the other things that are being stacked on top of AI data centers at the moment are things like autonomous vehicles. So here's a look at Waymo, which is the largest provider currently of driverless technology in the United States. And here's a look at California's data for 2025 versus 2024. And we only had data through September, but you can see just how dramatic the increase has been. In fact, it was a 450% increase year over year in driverless miles in California. And what's not all that shocking to people listening here is that all of those fleets, including the fleet that's being tested down in Texas by Tesla and some of the other emerging providers of driverless automated vehicles, is that they're all EVs. And so they have to get plugged into the same grid that these data centers have to get plugged into, that your residence has to get plugged into, and other emerging sources of electricity have to get plugged into. And so you're starting with a baseline of increasing electricity demand growth coming from things like, say, switching from a gas stove to an induction stove, switching from a typical HVAC unit to a heat pump. Those are incremental in terms of at the consumer level, the impact on electricity demand, but once aggregated, add another increase in electricity demand paired with autonomous vehicles. And one of the pieces of this challenging puzzle that we're trying to solve, frankly, with a number of puzzle pieces missing, is batteries. So if you look at enterprise level storage solutions or battery solutions, we've seen a massive increase over the course of the past couple of years. 2025 was a record year of battery installations. 2024 before it was a record year for battery installations. By 2030, you're expecting 160 gigawatts of enterprise level battery installations. And that speaks to the fact that there is no one bullet to save this. In fact, it's going to require very intelligent, very sophisticated people piecing together a very complicated matrix and mosaic of generation and transmission solutions that's going to allow us to meet this increase in electricity demand without a fall off in residential consumer pricing or an increase in consumer level pricing, but also without a fall off in terms of residential experience. Because from a political perspective, certainly the idea that we're going to be trying to plug all these things, most of which are commercial applications of electricity demand growth, while consumers are suffering as a result of it, either through blackouts or brownouts or the like, that is untenable from a political perspective. And it requires very thoughtful, very creative solutions that mix and match a number of technologies, some of which are legacy, some of which are newer and emerging, and speak to the opportunity that we have in front of us to invest in some of the companies at the core of this revolution. Another piece of the puzzle that we're stacking here in terms of sources of electricity demand growth is robotics. I'm sure many of you have seen the headlines coming out of CES earlier in the year where the stars of the show were not the people presenting, but rather the robots themselves. Apparently, we're going to have robots in our homes here over the course of the next 10 years or so. And certainly that's residential application of robot technology, autonomous technology. But I think the expectation is that we're going to continue to see commercial applications of robotics. And so if you look at the residential robotic market, globally, it's expected to be an $80 billion market by 2035. If you look at where we're expected to go between now and 2031, expected to grow global robotics at just shy of 20% compounded annual growth rate, up to 218 or plus billion dollars in terms of a total market just over the course of the next 5 years or so. Again, these aren't a source of electricity demand that you plug into your typical three-prong that you have in your house. These are probably 220 and are going to have a meaningful impact on overall electricity demand. It's the electrification of everything. It's transportation, it's supply chains, it's certainly overall having a meaningful impact on electricity demand. And when you think about automation broadly, whether it's robotics, whether it's autonomous vehicles, whether it's just the manufacturing process, as we try and reshore critical supply chain elements and get access to some of the important manufacturing elements of our modern economy, a lot of what we're seeing is investment in automation, whether that be robotics, whether that be electrified assembly lines. The takeaway is that electric power is coming from a number of sources. And yes, wind and solar are a big piece of that and will continue to grow their slice. In fact, they've been growing at a compounded annual growth rate well in excess of traditional electricity sources. But it's also true that those are high latency sources of electricity whose non subsidized cost has been falling, but still requires a trade off. And now, with the emergence of enterprise level or enterprise scale batteries and storage, we've seen massive adoption of batteries alongside wind and solar, which is helping us in real time to solve this very real problem between an aging grid, aging infrastructure, increasing electricity demand, and a need to invest. Well, here's where the investment lies currently and where the investment is expected to go in the grid. And so you look at Bloomberg's BNAF forecast for grid investment over the course of the next 25 years or so. And by the end of this decade, we're going to be spending $100 billion on the grid. And that's going to be annually, not in aggregate. And by 2050, the expectation is that we're going to be spending $132 billion a year on the grid. And where does that money go? It goes to copper, it goes to transmission lines, it goes to construction materials, it goes to cement, it goes to steel, aluminum. All of the components that are required to build a durable grid are going to be a piece of this overall investment puzzle. And so when you tie it all back to an investment portfolio, you think about companies that mine for and explore for copper. They often sit in the material sector. The material sector is less than 3% of the S&P 500. You think about the energy sector, which has been in the news lately as a result of the Iran conflict. That's 3% of the S&P 500. A critical component of this electrification theme is natural gas, which is responsible for 42% of electricity generation in the United States. That is another pocket of the market that people do not have a lot of exposure to. And then you get to the utility sector, which sit at the heart of this theme in many ways, because these are the companies, the publicly traded companies for that matter, who are tasked with providing residential electricity to consumers across the country while at the same time ensuring that they've got capacity in both generation and transmission to accommodate the commercial enterprises in their footprint. And utilities are now at a point where they've changed their stripes in many ways. They were this old, boring, consistent segment of the market that nobody really thought about until they were focused on income or they were focused on getting defensive in the marketplace. Well, what we're seeing is these companies are now at a point where they are ramping up their investment. Their CapEx spending is expected to grow significantly over the course of the next 5 years. And so this chart shows you that over the course of the past 10 years, the Edison Electric Institute, which is a consortium of all of the utilities in the United States, spent about $1.3 trillion over the course of the past 10 years in CapEx. And based on their survey at the end of last year, they're expecting $1.1 trillion in net new CapEx over the next 5 years alone. So there's an acceleration happening in many categories within this electrification theme. There's an explosion in electricity demand growth forecasts. There's an explosion in investment tied to this theme, both in terms of investment in the grid and, as you can see here, investment by utilities companies to try and accommodate this increased electricity demand coming from these new sources that are stacking on top of each other in a way that we really haven't seen in more than 50 years. And This is not just a US phenomenon. You look around the world, we're not the only country that has ambitions to electrify transportation, to electrify supply chains and manufacturing capabilities, to realize lofty AI ambitions and all of the electricity demand that comes with it. So the investment that we're talking about in the United States is also happening in emerging Asia, in emerging Africa, in developed Europe, as well as in emerging South America. So don't think about this just as a US only phenomenon. We're not the only economy who is undergoing a massive trend of electrification. This is very much a global phenomenon. And the more you can put it in the context of how investors typically allocate and the implications of this, we think make this a much more powerful theme than people probably even appreciate. Because when you think about the hyperscalers, the Mag 7, the companies that are at the heart of this market cycle, driving so much of the total return and the earnings growth of this cycle dating back to the correction in 2022, those are the companies that are largely responsible for driving rising electricity demand. You see those blue boxes on the left. Those are the companies that we view as the drivers of rising electricity demand. It's the companies who stand to benefit from the investment necessary to accommodate that rising electricity demand that are typically small positions in a typical asset allocation framework. In fact, we talked about how energy, utilities, and materials, three sectors at the heart of the electrification infrastructure theme, represent less than 8% of the S&P 500 by weight. If you look at the ACWI, the global index of all of the companies on planet Earth, the weights of those sectors are also less than 10%. So this is not a theme as defined by these companies here on the right-hand side of the chart that most diversified investment portfolios have disproportionate exposure to by default. If you're using a beta framework where you're buying the S&P 500 for your large cap exposure domestically, you're buying EFA for your developed ex-US exposure, then you're adding to that, say, an emerging markets portfolio from MSCI or based on an MSCI index. Your exposure to natural resources, to energy, to utilities is somewhat de minimis relative to technology, communication services, consumer discretionary, and certainly financials in the developed ex-US and emerging markets realm. What's unique about the electrification theme is that it requires exposure in order to capture it to companies who have small weights in the S&P 500 and in your major market indexes. And importantly, when you look and decompose what's in here, you can see that in some people's eyes, these things might be at odds with one another. Oh, solar cell companies paired with energy infrastructure companies transporting things like natural gas. You've got companies in the thermal coal segment or the uranium segment paired with renewable energy companies. That speaks to the nature of the electrification theme and the fact that there isn't going to be any one individual winner. In fact, there are going to be companies who are winners, and we've seen even pre-revenue, not just pre-profitable, but pre-revenue nuclear companies in the small modular reactor segment who have been big winners in the market. And naturally, I think that segment is very exciting because the advent of nuclear checks a lot of boxes. You can apply it subscale. It is on a relative basis emission free or close to emission free. But nuclear itself isn't going to get us to the place we need to be to solve this rising electricity demand challenge. Certainly, battery technology in and of itself is not going to get us to where we need to be in terms of trying to meet this insatiable appetite for electricity demand that is coming from the stacking of these emergent sources of electricity demand. What is clear to us, and as we talk about this, is that having a mosaic of exposures to the companies at the heart of the electrification infrastructure theme is going to help provide you with a durable exposure that stands to benefit from this. And frankly, we've seen market cycles historically where you look at the sector breakdown of the market portfolio as measured by a cap weighted view of it, and certain sectors rise to the top in terms of their weighting relative to others. Others' weights drop dramatically over time. It wasn't that long ago that energy was one of the biggest, if not the biggest weight in the S&P 500. It wasn't that long ago that financials was the largest weight in the S&P 500. And yet here we are with technology largely responsible for a lot of this rising electricity demand, north of 30% of the S&P 500 by weight. The seven companies that comprise the Mag 7 represent more than 30% of the S&P 500 by weight. Those are companies that naturally are in the business of increasing electricity demand, specifically through their AI ambitions. And at the same time, you've seen materials and energy and utilities companies whose industries within it give you exposure to where the investment is going. All of that grid investment, all of that utilities capex is obviously being earmarked for a lot of the services and resources that are provided by companies in these various segments of the market. And because of their low weighting in the S&P 500 and your typical market portfolios, they inherently provide diversification benefits to a portfolio that is quote unquote offsides in other sectors of the market. And from a factor perspective, from a thematic perspective, you can think about the electrification theme as in many ways providing a multitude of factor, cyclical, and economic benefits or exposures that all come together in a unique way. So utilities, as we talked about, a defensive sector of the market, historically one of the lowest volatility sectors in the S&P 500. If you look at a portfolio like ELFI, our electrification infrastructure ETF, it's got about 40% in utilities. So you've got some defensiveness to the core, even if utilities, as we talked about earlier, have changed their stripes and have become a little bit more growth oriented as a result of the CapEx investment that they're undertaking and that they're expected to undertake over the course of the next 5, 10, 15 years. Whereas in the middle of the portfolio, you've got some cyclical and growth oriented exposure, whether it's in the metals and mining segment within materials, whether it's some of the oil and gas and or other fossil fuel related companies in the portfolio. And then you've got these durable tailwinds. If you look at the battery technology space, we talked about how quickly that's grown. Solar applications have grown dramatically in the United States. There is upside potential in uranium, as well as small modular reactors and even traditional nuclear. But one of the things that's really fascinating, I would say, about the combination here is that in some ways it breaks with some of the dogma that people might have about renewable versus fossil fuel and speaks to the fact that if we're going to solve this problem, which is a complicated one, we're going to need to apply a number of different technologies. Some are legacy, some are emerging. And importantly, if you don't have exposure comprehensively to the companies at the core of this, you really risk having your portfolio left behind. And an infrastructure, an electrification infrastructure strategy like this, focused exclusively on equities, we believe is a core piece of an electrification infrastructure strategy. But importantly, it's not the only piece. In fact, having exposure to the commodities themselves at the core of this evolution in the market provides a number of things. It provides inherently diversification. If you look at a basket commodity strategy, very low correlations to fixed income and equities. If you look at the nature of commodities returns over various cycles and where we're at in the current cycle, it is trending very much like other investment cycles that we've seen in the commodities markets historically. If you look at capex in the oil and gas and commodity space, so metals and mining, over the course of the past 15 plus years, what you'll see is in real dollars, we've been on the decline in terms of real capex spent by oil and gas exploration companies as well as metals and mining companies over that period of time. So underinvestment met with increasing demand for these resources is putting upward pressure on prices. And if you look at copper, for example, which is perhaps one of the most important inputs into electricity transmission and infrastructure build out here, it's expected to be in a deficit from a supply and demand perspective, not just next year or the year after, but at least for the next 5+ years, as some of the expected capex starts to catch up with the imbalance between supply and demand that we're facing over the course of the next few years. And if nothing else, what we're seeing in Iran doesn't necessarily map to this big secular trend that we think is playing out not just over the next decade or so, but over the next 25, 30 years. it speaks to how thin the margin is for these commodities globally. In fact, all of these commodities, whether you're talking about the metals and miners critical to this, whether you're talking about the base metals, or you're talking about the energy sources themselves, they all live on a knife's edge. And when you have disruptions geopolitically, it just highlights how fraught the global commodities market is and how challenged some of these supply and demand dynamics are globally. And so, if you're thinking about anything on the back of this presentation, it's that electricity demand is expected to explode over the course of the next 10, 15, 25 years. The implications for that from a portfolio perspective are not necessarily reflected in the portfolio building blocks that most people use to build their asset allocations. And in order to go out and affect this view and get ahead of the reallocation or reorientation of the sector, breakdown of the market, as well as the key components of this electrification theme, you have to go and search and seek out exposures. There's only four energy infrastructure names in the S&P 500 in a sector that's less than 3% of the S&P 500. These companies have already proven that they're striking deals directly with data centers to provide natural gas so that they can get behind the meter power. If you look at the material sector, which is critical to this theme, it's less than 3% of the S&P 500 by weight. If you look at the utility sector, again, 2-3% of the S&P 500 by weight. Commodities are typically not a core building block in a lot of diversified asset allocations. So in order to get ahead of this theme and the implications from a portfolio construction perspective, instead of simply building portfolios with what has worked over, say, the course of the past 10 plus years, 15 plus years coming out of the GFC, and more recently in this current cycle, it's going to take and require advisors and allocators working on behalf of individual investors to rethink the ways that they build their portfolios to be durable and to participate fully in what we feel is the most powerful secular theme in investing. So I'll take a breath. I know that was a lot. I appreciate everyone's patience. If there's any questions, we're happy to dig into them.
Meg, any questions come through a queue at all on your end?
I'm not seeing any, but anyone with questions, you can unmute or put them in the chat.
And if there aren't any questions, feel free to just reach out to Megan directly or myself. Megan will provide the recording after this with my contact information. And just again, to summarize, thank you, Paul, for that. I mean, we're just seeing a torrent of investments going into the electrification movement, and you'd be hard pressed to not find any sort of headline in any publication nationally or locally. And truly want to encourage you to reach out to look at some of those local projects that are out there, because they really are going to have a lot of what we've talked about in that the guts of the electrification movement. But there is a question here, Paul. Let me read it out to you. Can you share a little bit more about how the war in Iran affects your analysis?
Yeah, thanks, Susan. This is a good question because it in many ways underscores how difficult the current outlook for commodities markets is, and just how risky the supply chains for a lot of the inputs into electrification are. And we saw it last year. So before the Iran conflict broke out, and we're now seeing disruption to things like aluminum, which is a massive input into electrification and manufacturing of things like electric vehicles, as well as transmission infrastructure. We're also seeing disruption to helium, which is, of course, an important input into chip manufacturing globally. That speaks to just how complicated global supply chains are and how much geopolitical risk exists, and whether or not these commodities markets broadly are pricing in that risk. But even before the Iran conflict, if you weren't paying attention last year, you might not have noticed it, but Freeport-McMoRan, which is one of the largest global producers of copper, had to declare a force majeure at one of their properties in emerging Asia. And the reason they had to do that was because there was a typhoon that hit the property. And immediately you saw global copper prices rise by about 7%, and Freeport McMoran stock fell by about 8% in that moment. So these small, in that case, and now bigger implications from either geopolitical tension or natural disasters have a disproportionate impact on the prices of individual commodities and speaks to just how challenging it is when things are operating as normal, let alone when you have disruptions to the global marketplace. So if anything, it underscores how critical these resources are to what we're trying to accomplish and how difficult it can be to secure those natural resources and how important the companies who are out there mining for, exploring for, refining, and producing these various commodities and natural resources are to our economy. In many ways, AI and the application of it gets disconnected from the real world in a sense of I go into my computer, I go into my phone, I type a prompt, something gets spit back at me. But in between me entering that and it coming back to me is a lot of real assets, hard assets, transmission lines, fiber optic cables, cement, steel, all of which is necessary for that LLM, that AI protocol to be able to deliver exactly what it's promising to me. And so, in many ways, I would say the conflict in Iran underscores just how fraught global natural resources markets are, even on a good day. So there's another question here from Kathy about the advantages of the Midwest in terms of being positioned for baseload generation, access to resources such as MNs, Iron Range, and access to water. I would say it is extremely well positioned. It's part of the reason why we saw a new announcement for a large data center project in that location. The water piece of this is also fascinating because in order for the cooling systems at these various locations to run efficiently, you need access to water. And if you think about Texas or you think about some of the southern geographies where data center projects have been started and are under construction, water has been a meaningful impediment to their ability. Now, there's companies working on other solutions for cooling, whether it be a ion-based solution to cool a facility. But again, we're in a moment where there's not a lot of patience in terms of application. And what I mean by that is we can't wait around for small modular reactors to be applied at scale. We can't wait around for new cooling solutions to be developed, to be tested, and to be applied. A lot of these companies want it and they want it now. And ultimately, locations like Minnesota and those up near the Great Lakes have trade-offs. They have access to water in a way that other geographies don't. They have access to some of the raw materials themselves, which other geographies don't. But at the same time, it's a highly regulated relative segment of the country. In theory, the companies who are looking to build a data center project up there will have to make concessions in terms of what they're willing to pay for and what they're willing to invest in to not impact residential electricity prices. And that might not be the same experience that someone building a data center project down in, say, Texas has because of the abundance of natural gas. In fact, right now, down in the Permian, natural gas is trading negative because there is no ability for those companies to get that natural gas to places where it's in high demand. And so it's effectively being given away for free or companies are paying for it to be offloaded. So there are a number of mitigating factors that make various geographies more challenging than others. But I would say Minnesota and the local region up there is somewhat well positioned, if not for the heavy burden of regulation up there. So the question from Scott is the capital required for utilities in the grid as regulated returns. How does that cause the timing to be pushed way out? Well, it's a really good question, Scott. And we're going to be doing another webcast on this topic with our partners at Vetify tomorrow. And joining us will be the guy, Mark McLean, who actually built the index underneath our electrification infrastructure ETF, Elfie. He works at Ladenburg Thalmann. He's been in utility finance for 25 years. He lives and breathes this stuff. And he's probably better positioned to give you more perspective and context on how the highly regulated nature of the utility sector is grappling with the need to get approval to spend this type of capex to realize these lofty ambitions in terms of generation and transmission capacity while being hamstrung by rate caps. And what we're seeing is a trend, at least a recent trend, around companies going and winning their rate cases in a given state. So the regulation is a burden and it makes for a sector that is historically defensive while at the same time restricting their ability to grow and to invest in the way that other sectors of the market would. The other restrictive component to all of this, Scott, is that 29 states in the United States, including District of Columbia, have renewable portfolio standards. Renewable portfolio standards are commitments by individual states to have a certain share of net new generation come from renewable sources. And so naturally, if you're trying to ramp up electricity generation and therefore transmission as well as quickly as possible, and yet you're beholden to some renewable portfolio standard, it can create a mismatch between timing and ambition. And it speaks to how complicated this problem that we're trying to solve is. And I do think very smart people are working on this 24 hours a day. But it's a great example of, in many ways, the challenges of a sector that is core to this having a very highly regulated nature. And you may have seen, Scott, the relative performance of some of the independent power producers who don't face the same regulations has at times in this cycle outpaced the performance of the more regulated utilities in the category.
I don't see any other questions coming in. I just posted the link for tomorrow's webcast in there if people want to listen to that for Scott and yourself and some others. So um, feel free to join with that. I know we have a few minutes left, but again, thank you everyone for your time in joining with this. Megan, any last words? Feel free to wrap this up. But thank you again, Paul, for everyone to join.
No, just thanks you guys for this great presentation and everyone for joining.
Yeah, have a great day, everyone. Thank you.
Thanks,
Thank you
guys.
again. Take care.